Was the copper corner key to the panic of 1907 crash? Imagine trying to corner a market and ending up causing a financial earthquake. That's what happened with the copper market in 1907. It all started with two brothers, F. Augustus Heinz and Otto Heinz, who were big names in copper mining and banking. They wanted to control the copper supply by buying up a lot of shares of the United Copper Company. Their plan was to force short sellers, those who borrowed shares betting the price would fall, to buy back at higher prices, creating a squeeze. They bought so many shares that the price soared, but they overestimated how much control they had. When the short sellers found other ways to cover their positions, the copper stock suddenly plummeted. This sharp drop shook investor confidence and caused a ripple effect. Banks and trust companies that had lent money or invested in copper started to worry. Many of these institutions had lent heavily in the stock market or held risky assets without enough cash reserves. When the copper stock crashed, depositors rushed to withdraw their money, leading to a liquidity crisis. This was a big part of the larger panic that was already brewing due to over-leveraged investments, industrial monopolies, and declining stock prices. The failure of the copper scheme exposed these underlying weaknesses. It also triggered a chain reaction that affected other banks and trust companies, especially those linked to Heinz and his associates. Some trust companies had lent money without requiring collateral, making them especially vulnerable when confidence evaporated. As the crisis worsened, J.P. Morgan stepped in to help stabilize the financial system. He coordinated efforts to support struggling banks and companies, including U.S. Steel, which was formed shortly after to help consolidate and strengthen the steel industry. The Panic of 1907 showed how a single market manipulation could expose systemic problems in the banking system. The copper corner was a catalyst, but it was part of a bigger picture of economic fragility. It revealed how interconnected and fragile the financial system was at that time. This event led to the realization that the United States needed a central banking authority, which eventually resulted in the creation of the Federal Reserve in 1913. So, was the copper corner the main cause of the Panic of 1907? Not exactly. It was a major spark that ignited the fire, but the underlying weaknesses in banking and finance had been smoldering for years. The failed copper scheme made those weaknesses clear and accelerated the crisis. It remains a key example of how market manipulation and risky banking practices can trigger widespread economic disruptions.